Welcome to the Deep Dive, where we break down the earnings calls that matter.
Today, we're digging into HIMS and HERS Health. Their Q2 2025 call was definitely one for the books. It happened August 4th, after the market closed.
Yeah, it really stirred things up. Lots to unpack, strategy, numbers, a whole 9 yards. A quarter that certainly got the market talking.
You can say that again. The immediate reaction was, well, let's just say cautious, even though some of the core numbers look pretty strong on the surface.
Okay, so let's start with those numbers, because it really was, like you said, a bit of a mixed bag.
Right.
So on earnings, they actually beat expectations. Quite nicely, in fact. GAAP EPS came in at $0.17, non-GAAP at $0.19. That's significantly ahead of what analysts were predicting.
Definitely a solid beat there, a clear positive on the profitability side.
But, and there's always a but, isn't there?
Almost always.
Revenue told a slightly different story. It landed at $544.8 million. Now, that's still up a massive 73% compared to last year.
Which is incredible growth. You can't deny that.
Absolutely.
Yeah.
But it was just shy of the consensus estimates. And you know how the street reacts to even a slight miss, especially with growth stocks?
Yeah, expectations are always sky high. Digging a bit deeper, adjusted EBITDA looks strong too.
It did $82.2 million, which is great year-over-year growth. That translates to a pretty healthy margin of 15.1%. Shows some operational strength.
Right. But then there's the number that probably raised the most eyebrows, free cash flow.
Yes, that one stood out.
It swung negative, minus $69.4 million for the quarter. Compare that to positive $47.6 million this time last year.
Oof. That's a big swing in the wrong direction.
Yeah.
What do you make of that? I mean, that's usually a red flag, right?
It certainly gets your attention, especially for a company that's supposed to be scaling profitably. You want to see cash generation, not cash burn at this stage. But we need to balance that.
Okay, how so?
Well, look at the subscriber numbers, still climbing. They hit 2.44 million subscribers.
Okay, that's up, what, about 31% year over year?
Exactly. And the average revenue per user, the ARPU, is also up 30% year over year, hitting $74 a month.
So more users, and each user spending more. That does paint a more nuanced picture.
It does. You've got this tension. Strong user growth and spend, great EPS beat, but then the revenue miss and that negative free cash flow.
So to really get it, we need to dive deeper. Let's look at those financial nuances.
Yeah.
The gross margin, for example. That was interesting.
It really was. It actually compressed year over year, dropped 500 basis points, 5 percentage points, landing at 76%.
Which isn't ideal. You want to see margins expanding generally.
True, but quarter over quarter, it actually expanded by 3 points. And they said that was mainly driven by growth in their other specialties, the ones outside of weight loss.
Ah, okay. So maybe some diversification benefits starting to show. Less reliance just on GLP-1s.
Seems like it. And what's really striking about that strong adjusted EBITDA margin, the 15.1%.
Yeah.
That happened even though they paid out about $7 million in severance and sign-on bonuses for new hires.
Wow, okay.
Plus, they had higher G&A costs, more spending on tech development, organizational changes. They absorbed all that and still expanded the margin.
How? I mean, that suggests some pretty tight cost control elsewhere, or just serious operating leverage kicking in.
Yeah, it points to efficiency in the core model. Also worth mentioning that ARPU number, the $74, it was actually down from $84 in Q1.
Oh, interesting. A sequential dip? Why was that?
Management said it was mostly because they offboarded some GLP-1 subscribers who were on the standard commercially available drugs.
Okay, so they're actively steering people away from branded Wegovy or Ozempic, for instance.
Towards their personalized compounded versions, yeah, where they have more control, potentially better margins long-term, and can build that deeper patient relationship, even if it means a slightly lower price point per order initially. It's a strategic choice.
Got it. That makes sense. And circling back to that negative free cash flow, did they explain that big swing?
They did. They were pretty clear it was due to deliberate investments in working capital, basically strengthening their supply chains and buying inventory up front, especially for GLP-1s, to ensure they wouldn't have supply issues.
So investing cash now to guarantee future growth and stability.
That's the narrative. And crucially, they said they expect to be back to generating positive free cash flow in the second half of the year.
That's key. The market will definitely be holding them to that. If it's just a temporary investment, fine. If it becomes a trend, less fun.
Exactly. And they do have the firepower. They ended the quarter with over $1.1 billion in cash and short-term investments. That's after raising some convertible debt back in May.
$1 billion.
Yeah.
Okay. And they still have a buyback program running.
Yep, about $65 million left on the current authorization, so plenty of financial flexibility.
Right. So the financial health seems robust overall, despite that FCF blip. Let's shift gears, though. Beyond the spreadsheets, this call was really about their big vision, their strategy.
Absolutely. The CEO sounded very confident in their precision care model, personalized care, high quality, but delivered at massive scale.
And the scale is impressive. 2.44 million subscribers, nearly 1.5 million actively engaging with almost 1,500 providers on their network. That's a complex operation.
It really is. And central to that whole model is patient retention. This was maybe the most striking stat they shared.
The GLP-1 discontinuation rate.
Yeah. They're seeing only a 25% discontinuation rate for their personalized GLP-1 treatments after 6 months.
25%. Compared to what? What's typical?
Well, they cited other studies showing discontinuation rates as high as 80% for GLP-1s in general.
80%. Okay, 25 versus 80 is, that's night and day. What do they attribute that massive difference to?
It comes back to that personalized approach. High provider engagement, customizing the treatment, using their app for support and tracking. It suggests their model actually keeps people on these potentially life-changing but sometimes challenging medications.
If that number holds, that's a huge competitive advantage. Churn is killer in subscription businesses, especially healthcare.
It really is. It suggests they're building loyalty and stickiness in a way others aren't. It could fundamentally change the long-term value proposition.
Okay, so retention is key. What about growth? New areas?
Big plans there too. They're launching into new specialties, specifically testosterone therapy and menopause care. They see this adding something like $30 billion to their total addressable market.
$30 billion, wow. And boosting ARPU too.
Yeah, they think these could lift ARPU by another 15–20%. And they said these offerings are coming relatively soon.
So moving beyond the initial lifestyle categories into more complex, chronic hormonal health issues.
Exactly. It broadens the platform significantly. And they'll offer both compounded options through their own facilities and partners, plus generics were available.
And they're building the infrastructure for this too, right? With labs.
Yeah, they bought a lab company recently. They're verticalizing testing, initially for these hormone launches, but the plan is to offer standalone lab testing down the line. Could be a whole new business category for them.
Interesting. Labs, compounding facilities. What's the end game here?
Seems like they're laying the groundwork for an even bigger push into longevity, potentially starting in 2026.
Longevity, that's ambitious. Very Silicon Valley.
It is. But perhaps more immediate is the international expansion, the Zava acquisition in July.
Right, the UK-based telehealth company. What does that bring them?
Well, first off, it's expected to add at least $50 million in revenue this fiscal year. But more strategically, it gives them an instant foothold and regulatory experience in the UK, Germany, Ireland, and France.
A beachhead for Europe.
Yeah.
Does that help with North America too?
Definitely. They plan to leverage Zava's expertise for their Canadian GLP-1 launch, which is slated for Q1 2026.
Canada. What's the plan there?
They expect to offer generic semaglutide, the active ingredient in Ozempic and Wegovy, for around 75 to 100 Canadian dollars.
75 to 100. Compared to what for the branded versions?
Currently, branded is like $200 to $400 there, so a massive discount.
And Canada has a big market need, right?
Huge. Something like 2/3 of Canadian adults are overweight or obese, so lower prices could unlock a lot of demand.
Okay, that makes strategic sense. Price disruption in a large market. Now, underpinning a lot of this expansion is technology, specifically AI. They brought in a new CTO.
They did, Mo El-Shanawi, and he laid out a really ambitious AI vision, essentially reinventing how they deliver care using AI.
What does that actually mean, though? What are the key parts?
Well, a few pillars. A unified data platform pulling in info from everywhere. AI-powered personalized agents, think chatbots, but smarter, providing 24/7 support, guiding patients through everything.
From initial sign-up to ongoing care.
That's the goal. Also, building a tech architecture that's ready for global scale from day one. And importantly, a big focus on AI safety, ethics, governance.
Sounds transformative. Not just tweaking things, but rebuilding core processes.
That's the ambition, making care more personalized, more efficient, maybe even improving outcomes significantly.
And they put a timeline on seeing results.
They did, actually. They expect tangible improvements in efficiency and patient engagement from these AI investments within just 3 to 6 months.
3 to 6 months. That's fast for AI implementation at this scale.
It is aggressive, shows confidence, but also sets a high bar for delivery. The market will be watching closely.
Okay, so lots of moving parts. Let's talk guidance. What are they forecasting?
For the next quarter, Q3, they're guiding revenue between $570 and $590 million.
Yeah.
And adjusted EBITDA between $60 and $70 million. That's around an 11% margin at the midpoint.
And for the full fiscal year, 2025.
Revenue projected at $2.3 billion to $2.4 billion. Adjusted EBITDA at $295 million to $235 million. So implying a margin of about 13-14% for the full year.
And they stuck to their weight loss target.
Yep, reiterated at least $725 million in weight loss revenue for the year.
Okay. Are there any key assumptions baked into that guidance we should know about?
One big one relates to how they fulfill those compounded GLP-1 orders. They're shifting more towards using specialized 503A compounding facilities.
Right. What's the impact of that?
It means shorter shipment cycles, maybe smaller orders each time, so lower revenue per individual order, but they expect much higher order velocity, more frequent orders per patient.
So the revenue recognition might look a bit different quarter to quarter.
Exactly. They expect this shift to lead to a steeper ramp up in weight loss revenue, specifically in Q4, as that higher velocity kicks in. It's a timing thing, partly.
Got it. And they also talked about an investment period, right?
They did. They were clear. They're entering an investment phase for at least the next year.
Right.
Pouring money into marketing and tech, building out these new areas.
Not sticking to their payback framework.
Yeah, they emphasize that. They still expect investments to pay back within 1 year. So it's not just spending for spending's sake. It signals they're prioritizing growth and building capabilities right now, even if it slightly pressures margins in the near term.
Makes sense. Play the long game. They also mentioned the older sexual health business.
Right, the sort of on-demand side. They're continuing to transition away from that towards the daily subscription-based offerings, which have much better retention and lifetime value. They expect that headwind to fade more significantly in 2026.
Okay, so setting the stage for potentially cleaner growth metrics next year, let's pivot to the market reaction. Because the stock did not like this report initially.
No, it didn't. It dropped pretty sharply in after-hours trading, heavy volume too. And interestingly, there was a noticeable spike in bearish options activity. Put buying.
So, despite the EPS beat, the market clearly latched onto the negatives.
It seems that way. The slight revenue miss, that negative free cash flow number, and probably just ongoing nervousness about the whole GLP-1 space regulation competition.
And maybe the stock had just run up too much beforehand. It was up, what, over 260% in the past year?
Exactly. That kind of run builds in massive expectations. There was basically no room for disappointment on any metric.
So even with management sounding super bullish on the call, talking up the long-term vision, AI, new verticals, the market focused on the immediate execution risks.
That seems to be the story. And you see that reflected in what analysts are saying too, right? A real split.
Yeah. What's the divergence there?
Well, some are staying cautious, basically saying, look, this is a lot to juggle. Can they really execute flawlessly on all these new initiatives, hormones, labs, Canada, AI, all at once? There's significant execution risk.
Fair point.
But others are looking at the pullback and saying, this is a buying opportunity. They see the huge market potential, the strong subscriber growth, the improving retention, and they believe in the long-term story.
So it boils down to your time horizon and your tolerance for that near-term execution risk.
Pretty much. The company's narrative is clear. Use acquisitions like Zava, build out vertically, leverage AI, and become this broad, tech-first, chronic care platform. It's compelling.
But they need to deliver. What are the key things investors should be watching for in the next, say, 6 to 12 months?
Okay, near-term catalysts. First, any clarity from the FDA on compounded semaglutide. That's expected sometime this quarter, Q3. Huge for the weight loss business.
Right.
Second, the launch of GLP-1s in Canada, planned for Q1 2026. How smoothly does that go? What's the uptake?
Okay.
And third, maybe a bit further out, a potential FDA filing for their own testosterone therapy product, maybe in the first half of 2026. Hitting these milestones cleanly will be critical to rebuild confidence and justify the valuation.
Flawless execution needed. Got it.
Yeah.
Okay, now for our favorite part, the speculative, not financial advice trade idea.
All right, let's have some fun. Remember, everyone, this is purely for discussion, entertainment purposes only. Do your own research. Don't sue us.
Definitely not financial advice. But here's an outrageous but maybe plausible thought, given everything we just discussed.
Let's hear it.
We're calling it the leveraged buyback double down play.
Ooh, intriguing. Explain.
Okay, so HIMS and HERS is sitting on over $1.1 billion in cash. Their current buyback authorization only has $65 million left.
Right, a tiny fraction of their cash pile.
Exactly. And management literally said on the call they have greater confidence to accelerate strategic levers, and will take advantage of moments when we believe the market value of our stock meaningfully disconnects from its intrinsic value.
That's pretty direct language suggesting they think the stock is undervalued after the drop and they have the means to act.
Right. So the trade idea is go long HIMS and HERS shares, but pair it with a short position.
Shorting what?
Short a basket of traditional healthcare incumbents. Think legacy telehealth providers, maybe some pharmacy benefit managers, companies whose models are directly threatened if HIMS and HERS actually succeeds in democratizing precision medicine and shifting care towards prevention.
Okay, long the disruptor, short the potentially disrupted. Makes sense. What's the outrageous part?
The outrageous part is betting on the timing and aggressiveness. You're betting that management won't just sit on that cash or wait for the long-term investments to pay off. You're betting they use that post-earnings stock dip and their explicit commentary as justification to announce a massive new share buyback soon, or maybe even make a smaller bolt-on acquisition very quickly to signal extreme confidence.
So you're betting on a near-term capital deployment catalyst to re-rate the stock much faster than the market expects, while the shorts on the incumbents benefit from ongoing structural pressures.
Exactly. It's a bet that management puts its money where its mouth is very publicly and very soon, shocking the market out of its near-term caution. Highly speculative, depends on management psychology almost.
But plausible given the cash in the comments. An interesting angle.
So there you have it. That's our deep dive into the HIMS and HERS Q2 2025 earnings call.
Definitely a complex quarter. A clear EPS beat, but overshadowed by that slight revenue miss and the negative free cash flow print.
Leading to that cautious market reaction, even though management painted a very ambitious, very bullish long-term picture. New specialties, international growth, a huge AI push.
The strategy is bold. Now it all comes down to execution. As we said, flawless execution on those upcoming catalysts is absolutely key.
And just one last reminder, everything we discussed today is for informational purposes only. It is absolutely not financial advice. Investing carries risk. Please do your own homework.
We'd really love to hear what you think, though. What stood out to you from the call? Are you more focused on the near-term headwinds like the FCF or the long-term potential of the strategy? Where do you see the biggest risks or opportunities?
Let us know. Join us next time on the Deep Dive for another earnings breakdown.